Yep, everybody feels it, everybody knows it, and people that I know that have traded in funds or on Wall Street in banks for 20, 25, sometimes even more years, all say something is off. Bear's dead, Black Swan portfolio's dead, value investors dead, 16-year-old Robinhood traders rich. Actually, that's not the case. SPX all-time highs, and it goes on and on. And a stat that doesn't surprise me, SPX at all-time high with 39% of components below their 50-day moving average, which is down from 91% above their 50 moving average at the beginning of the year. So markets keep going up, even though there's some of the biggest statistical divergences between breadth and market price levels that have ever been recorded in some cases. Fear and greed index, we're in extreme greed. It's a nice chart, but in the end, there's a dynamic that's powering all of this. There's something very important that some are just starting to speak out about. And you never can build a healthy market with 7 stock listings being the primary, carrying the entire market on its back. That's nothing that will ever be a sustainable structural situation. That's something that when it lets go, it's going to let go ugly, just like Nvidia and the move that it's made recently off of even a prior very significant move. And in reality, there's only one thing that can cause a market to trade like this. Markets never ever trade like this in a normal organic auction market process. So basically, we no longer have an organic auction market process. It's been ruined or tainted by Fed discount window money. So 3 Fed meetings back, from that point going forward, the amount of Fed discount window money that I'm watching those that are tracking it is like $1.5 trillion plus now. Just 3 Fed meetings back till now is what's estimated is gone. And one estimate, a person has it at 2.2 trillion. Now, the investment banks have been playing with Fed discount window and the money in the market again from March of 2003. But 3 Fed meetings back, 18, 19 weeks ago going forward, it went into full tilt mode at levels never seen before. And that creates this. There's no auction market process. All selling is being absorbed and the markets are continuing to press higher. So some of the questions are, why is this being done? Theories are the investment banks are being allowed to make themselves as pretty as possible, either before a commercial real estate bust, which will take some banks out, or some sort of precipitous US dollar devaluation event. Those are the 2 primary things that I see the most experienced of traders that have spent the most time in Wall Street. Those seem to be the 2, fields of thought as to why investment banks are being allowed to play with Fed discount window money, which is a leftover old provision from 2008, 2009, too big to fail. So obviously the current administration and the Fed are allowing this. And we have hedge fund manager, well-known David Einhorn, saying markets are fundamentally broken by passive investing and quant investing. It's kind of sad. I mean, he says that, but he misses the opportunity to say what I know he knows and say, why are investment banks, why are they able to keep using Fed discount window money in the markets? So why did the biggest gamblers get flown to Vegas, get put up in the hotel, and get to go play with markers all day long? They don't even have to bring in any of their own money. And then at the end of the day, whatever they made, they get to cash out and turn it into cash. So in other words, the unending liquidity that's being used by investment banks to buy stocks, options, and futures is taking away what would be considered a normal auction process. So every and all statistics of the market activity from the past means nothing in this type of environment. And I can't believe on Twitter how many people I've seen 20 years, 25 years, 27, even 30 years say all of their models that they've traded with for all these years don't work right now. They can't comprehend the differences and divergence between real fundamentals or flows and what the market's doing. And a lot of the big funds have had net outflows. BondPA is not buying the market. They keep cashing out. They're pretty much out of the market at this point on the sidelines. A large predominant portion of the BondPA is out of the market. They might be sitting investments, but they're not net long U.S. stocks at this time. In other words, the predominance of their portfolio has been made much more conservative, or in cash, or guaranteed or bond type investments, guaranteed investment contracts, not money market, but just stuff that doesn't have the risk and exposure of the market to the long side. So yeah, it's been really interesting. Those that I'm tracking that are tracking this, and they're getting more and more, I guess you could say, info from others that are aware of this and passing on better ways for them to track it. And it's been really interesting on some of these private chats to be tracking some of this. And it's basically fund manager, fund level groups that are watching these massive statistical anomalies and the imbalances each day on the amount of stock selling, meaning people are taking profits, growing and growing, but the markets keep going higher. And a lot of it, they say, is what they call a zero DTE options trade / futures trade. So there's an automated trade where they're using, investment banks are using options and futures buying like tugboats to keep towing the barge higher. So I've heard some people call it the perpetual motion trade. They can literally create perpetual motion of price movement that's unopposed. Now, just realize, for those of you that are net long in 401ks or stock market, when all this liquidity starts coming out that's jam-packed in the very uppermost range of the market, we're talking very slim range, the sell-off that could take place could make the flash crash day look like a joke. So you got to really be careful. And remember, if you're alongside in futures trades or FX indices trades, stops will theoretically be getting jumped, because if smart money starts selling, they're not going to be buying on the way down, and the market makers aren't going to be absorbing on the way down either. They're going to get out of the way, which means you're going to have big gaps in price on the way down. So you could have some amazing downside moves that have really never been witnessed before. So you're in non-standard markets. Be aware. Trade smaller size than normal. And we're getting close. This is an unsustainable rally, especially since it's not organic. It's not built on people buying stocks, buying options, buying futures, because they all think that the market in general or the economy is great. This is a gamed rally built on Fed discount window money. So anyhow, if you have any questions about the markets or systems, just let me know. info@gridalgo.com. Talk to y'all later.